board. The bonds are down, the notes are down, oil is down, gold is down. Like everything over here is red. The only thing I'm showing up is Apple and Tesla, and a couple banks, Bank of America, Wells Fargo. Um, them shouldn't even be on my watch list. I don't know why I thought I took them off. Let me take them off. All right. Um, but what I wanted to talk about in this video is efficient use of buying power and efficient use of buying power. So we want to talk about how you can get the most bang for your buck, basically. And this conversation came about, like I said, my buddy of mine we were talking about Tesla, and he said that he had a buy order, a limit order to buy Tesla at 144. And Tesla never came back to 144, or it hasn't since he put in his limit order. So it just ran away from him. And I was like, oh, man, that gave me a great idea to do this video. And I'm just saying, when you have a bullish biasness or short, you want to short something, you don't have to necessarily get the perfect price. Like if I want to buy Tesla at 144 and that's the price I wanted at, I could come in here and on the option tab, I'm on TastyWorks, and me personally, my sweet spot for trading options is right around 35 to 65 days. 35 to 65 days if I'm trying to get directional. If I'm doing iron condors, I want to be around 55 to 90 days. And you may say, like, now I'm not planning on holding the option that length, but it has to do with how long I do plan on holding it. So like with an iron condor, I'm doing 55 to 90 days, but I will hold it no longer than like 30, right? But I wouldn't want to do it at a 35 day and be holding it down to 5 days. And that's why I choose these time periods. So now, Tesla. So I would come in at 42 days, right? We only got to do let's do 28 days. And I could come in here right around 28 days. Now he said his price for Tesla was 144. If that's the case, that's way down here at the 9 delta. He could come down here and sell this put at 144. Now, I'm going to do 146 to make the math easy. I'm going to take right click, delete that, and I'm going to show you the reason why I'm doing it. I'm going to make the math easy. And I'm going to come in and lock this in at $2, which is $200, right? At 146. Now, you may say, what if Tesla never comes down and you never get that opportunity to get it at 146? Guess what? You keep these $200. So instead of setting a buy limit order down here at 146, you sell a put at the strike that you would like to own it. If it never comes back, at least you got the $200. In 28 days, if it never comes back, just keep the 200. You didn't lose nothing, but you gained something. If it comes back down there, and let's say it comes down here and you get put the shares, you wanted it anyway at that price. So if you get put the shares, then guess what? Not will you wouldn't own this you wouldn't get put the shares at 146. Well, you would, but remember, you took in $200. So instead of having this at 146, right, times 100 shares, which would be what, $14,600, you'd have it at $14,400, because that $200 that you collected in premium would lower your cost basis. It would come out of that total amount. So instead of you just buying it outright right here, now same thing. I can up this and also with selling this put, it's only going to take your buying power of $5,170. Excuse me, $5,107. That's how much you'll get margin. If you would have just bought this, if you bought it outright, you're going to get margin $14,000. If you bought it right here at the price that it's at, I wouldn't advise, me personally, I would never buy a stock right at its price. Why do it? Even if you, let's say for instance, let's take out charts. We don't care about charts right now. Let's just say I want to buy, I'm long Tesla. And it said, man, I want it. I want it at, I buy it right here at 190. So you mean to tell me you go ahead and buy 100 shares? Click up here at ask, click on the ask. Turn this to 100 shares. Now, that means they're going to margin you $9,520 if you buy this right here at $190. Now, that's because they're only margining 50% of the total price. Now, let's clear that out. $9,500 margin, clear it out. How about if you just sold a put? If you just sold a put. Now, it's margining you, your buying power is close to the same thing, 9,400. And you say, man, I didn't really, now, but you took in $1,460 in premium. So this, if you got put the stock, instead of owning it right here, this amount will come out of your cost basis because you took in this much in premium. So when you sell puts, you're reducing your cost basis. Selling a put is almost always better than buying shares unless you're day trading. If you're day trading, like if I was in this and I was looking at a minute chart, I'm looking at a 1 minute chart up here. If you look up here at the top right, this is what Tesla's doing minute by minute. And I'm looking at this and I'm like, man, these next few minutes, I think it's going to hit the 190, and I jump in and buy 100 shares. Because then at that point, I'm making $1 for every move, right? So it moves up $1, I make $100 if I buy 100 shares and so forth. So that would be the only reason why you would want to do that. Any other reason besides day trading, you selling puts to get, even if you want to come in the money, like you come in the money, sell it in the put. So if you sold like a put like right here, you came here and sold this 51 Delta and took in 1,700 right here. Well, what they would call like a poor man's covered call. You could come in the money and sell a put, and increase your chances of getting put to stop. But these are ways, and looking at this stock right now, I do think it's gonna pull back at some point. Now it could keep running up here and fill this gap, right? We got a gap up here. And before I get to, we only got like 3 minutes in this session. I did close this trade right here on the bonds on this big down day today. I went ahead and closed it out and took profit and got out of that position. I don't want to be sitting in it after a big down day like today. I don't know what it's going to do over the weekend. You could get a pullback. Now I am looking at continuing to, I may put on another trade, another bearish trade in the bonds. You can see I got divergence right here. That's why I got this bar. I got this lower low. Kind of shook me a little bit right here, but then we got back down today. Said, look, I'm gonna go ahead and take what little profit I got, and then maybe look to reestablish that position. Now let's go back to Tesla real quick. And I'm just using Tesla because me and my homie, this is what we were actually talking about, Tesla. Selling puts. That's what I have in this Novavax position. Now I'm down on the position, but check it out. Let's make it big. Are you tripping? Come on now. There we go. All right. So if we're looking at this position, I sold a put. Let's go look at it. I'm 42 days out. I own this put right here at the $10 strike. I collected 111. As you can see, you can't see yesterday. If I go, here we go right here. Here's the price. This is what I own, and I own it at 111. Now, if the market were to go against me and I held this down to and I got put the shares, guess what? I'm gonna get put the shares at $10. So you got 100 shares at $10, which is what, $1,000. But you guess what? Because I didn't buy it outright and I sold a put, my cost basis will be reduced by this premium of 111. So I'll be in the stock for $8.89 or $889 instead of just buying the stock right here. So we can see that the market actually gapped up and I got in it. I can't remember if I think I put it on yesterday. And I'm in it right around here. And you can see my my targets where I think it should go. But even if it doesn't, right around here at $10 is where my short strike is. Now I got 42 days, so more than likely it can come all the way down here. That doesn't mean I'm gonna get put to shares, right? Because I still got 42 days to go. And when you what you're looking at is the extrinsic value of the short option. When you're trying to determine whether or not you're gonna get put to shares, right? It doesn't pay a dividend, and I'm not on the call side, so I'm not really worried about that particular aspect. But selling puts, in my opinion, is the best way to get long stocks. Like figuring out how to selling puts may be the best option trading strategy out there. Selling puts and maybe doing strangles, which is all it is. All the strangle is you got this put here. It would be me selling the call on the other side, right? Something like that. Now, I don't want to sell. I look at Novavax. If I'm not mistaken, Novavax is, let's look at some. It's in the NASDAQ. So, and if I'm not mistaken, it's one of the, it says Novavax Johnson & Johnson dispute prepayments for canceled COVID shots for world's poor. So Novavax is a big player in the COVID-19 vaccine, whatever we got going on with that, right? So pretty much, if we get a breakout or some people get sick, I would imagine that this stock will go up. But that's not why I traded it. I seen it had has a high IV rank, and I got a little juice for selling the put, and I like the chart. So based upon that, I'm like, look, I'm in. Excuse me. And so with me seeing this crossover of this MACD up, pull back, I'm in it right here. So we'll see what happens with that. Instead of buying, now I could buy. Now, if I bought shares and I'm right, I'd make a whole lot more money. Buying shares and it jumping up to $21, that's a whole lot more money than the put that I sold. However, selling put it, I would have more risk if I would have just bought these shares. If I bought 100 shares, I'd be into this trade for $1,000 instead of the $111 that I'm, managing with selling the put. And also with selling puts, you can also roll them out. You can roll them out in time. And so that's just one of the things that I want to talk about as far as like being efficient with your buying power. You can do a lot with options, and you can set up an equivalent trade as to buying shares. Now, some people like to buy shares because it's just, it's just easier for them to do rather than to learn the mechanics of options. And if you have a large enough account and you don't really need your money, I'm not opposed to that. But if you somebody that like you say, well, I'm trading because I like to make some money and use the money or whatever. Like you ain't Warren Buffett don't need his money. He don't need it. So he can buy however many shares and just sit on it, and it can go down. He can wait till it go up. He can afford to do that. I've had some people that I've had signed me up or through Upwork for me to help them with option trading, like to, help explain things to them. And I'm talking about talking to people like the last guy. He he had I want to say he had an account the largest account I ever seen that I seen with my own eyes. I've heard of people with money like this, but I seen an account and I'm looking at his account. He showed it to me and he was like, um, he was buying shares of Tesla and he might be down like 50 grand or 60 grand. And he like, whatever. He holding it. And he'll hold it till it go back up. And then he'll take a little $10,000 profit and then buy it again. But then again, that's what I'm saying. It's levels to it. If you somebody and you don't have a $500,000 account or $1 million account, then you may not be able to just sit through those swings. I would advise when trading something like Tesla, just me, I'm coming out here and you see this little dotted line on TastyWorks. As far as I know, they have the best to me. This is the best option chain you're gonna see. And let me just explain to you this first dotted line. That's what they call one standard deviation. If I were to go to the curve, which is to show you, now you can see, you see this 28 days out, which is why I went 20. This is one standard deviation or one sigma, right? This is this is this would be a normal move for Tesla to be within this range. Now the ruler part right here is the formula that TastyWorks uses to come up with their own expected move based upon like the buying and selling of options on the option chain, and they have a proprietary way of how they figure that out. They have the math for it, or you can look it up, but you know, this is what that is. Now, this is one standard deviation. This dotted line out here is two standard deviations. You can literally come out here every 28 days and just do, I wouldn't do it to the downside. I would do it, if I was going to do this, I would be somewhere up in one standard deviation, right? So anything inside of this is a normal range, which means like, I think the standard deviation I want to say is 68.7 if I'm not mistaken. So 68.7% of the time, Tesla's movements are going to fall within this range. You can come out here and just, you see how, and you can see how the market is showing me down here just by selling that strangle, taking in $600, 77% chance of probability of profit. And I can increase that if I say I don't need the whole 600. Just let me get 305. I got an 88% chance of getting that. So you can sell one standard deviation strangles and Tesla and just chill. This is it's only tying up $7,000 worth of buying power. This is efficient use of buying power. And now you can go buy 100 shares and sit through the fluctuation of it moving, or you can just sell strangles, or you can just, you really want to own it, come over here and sell a put. I will come to the maybe the 35 delta 26. I'll be right here sitting at this 26 delta right here where you see these 2088 contracts. I'll be right here. Let the market come to me. Pick it up here instead of buying it here. If it never comes down and it keeps running away from you, keep the $650. Make 600. Even now, I'm gonna show you something else, and you may say, "Well, that's 28. That's 28 days just to make 660." You may not. You may say that's not a lot, right? And so you want. Let's keep it here. Let's do this. Let's keep it right there. Now let's look and see what this option at 170, what would this option be worth if, let's lock it. No, matter of fact, well, just remember 660. Clear it out. 660. We're going to go to 21 days. Go to 170. That same option lost if the market just oscillated where it's at. That same option 1 week later, from this Friday to the next Friday, is now worth $445. That means you made $200 in a week just sitting on a put that you sold. It could go up, it can stay down a little bit, it can oscillate, move around. $200 for one contract. If you want more than that, do 5 of them. That means you would have made $1,000 in a week without owning the stock. If you bought 5 of them, it'll margin you roughly, let's say $40,000. If you buy 1,000 shares, let's look and see what your margin gonna be. 94,000 is what they margining you for 1,000 shares of Tesla. I like having $40,000 margin instead of 90, being on the hook for that. And that's just because this is TastyWorks. A lot of other different brokerages, some of them may margin you all of this. They may margin you the whole, the whole thing. But TastyWorks is gonna go only margining you $94,000. Let's call it 95. So this is how you can use options to have a more effective use of, or a more efficient and more effective use of your buying power. So hey guys, hit that like button, hit that subscribe button if you got something out of this video, and let me know what you think. Let me know what you're trading. Let me know what you got on your mind next week, and I'll be back with another video probably this weekend or maybe even Monday. We'll see. With that, guys, I'm out. Peace.